Welcome to Trading Day. I'm Matt Scooby. Let's get to some stories that we are following in the BNN Bloomberg newsroom today. Oil prices surging today after U.S. President Donald Trump said strikes in Iran will continue. In a primetime address delivered last night, Trump saying U.S. forces have significantly weakened Iran, calling the military campaign unstoppable. However, Trump added that operations will continue until objectives are fully met. The U.S. president also threatening to strike Iran's electric generating plants again if a deal to end the conflict isn't reached. Canada's trade deficit widened sharply in February, missing expectations. Statistics Canada says the trade gap grew to $5.7 billion, the largest since August. The move came as imports jumped to a record high, driven largely by a surge in gold purchases from the U.S. Imports of metal and mineral products also climbed more than 45%. And Deloitte cutting its forecast for Canada's growth. In a report, the firm slashed its forecast for Canada's economy by 20% and predicting real GDP is set to grow just 1.2% this year. Deloitte says soaring energy prices linked to the war in the Middle East will weigh on consumer spending as well as businesses and will further impact economic challenges and uncertainties ranging from foreign trade to a soft labor market. Let's have a quick check on the markets. They've clawed back some earlier losses. The TSX currently sitting above 33,000. Again, with that market least for now, was hovering over 100 points earlier for now, but again, 0.3% gain on the TSX in Toronto so far today. South of the border, things are in the red, but maybe not necessarily nearly as low as expected. Again, there were some early losses on the futures board this morning. And again, markets have clawed back a little bit. Dow Jones still down almost 0.5%. Over the course of the day so far. But again, lots of volatility given what we heard last night from U.S. President Donald Trump. Well, Canadian stocks continue to stand out with the TSX outperforming year to date. That comes even as global markets stay volatile, driven by energy shocks, sticky inflation, and shifting rate expectations. For a look at why the TSX is the winner amid the global market volatility. Dec Malarkey joins us now, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, thanks for being here.
Great to connect, Matt.
You know what? We talk about this too, and we outlined all the different, how volatile I think, especially the last 5 weeks have been, given what's happening with the conflict in the Middle East. But the TSX has been pretty sturdy, at least in the last little bit. Certainly understandable with the energy prices. Is that the main reason for that? But give us a sense right now.
No, that's a big part of it. I mean, everyone had entered this year, even before this happened, having this view. Okay, you need more diversification. You need more hard assets in your portfolio because people thought, okay, you may be, certainly in the case of the S&P, too much exposed to tech. So, I mean, not only is the TX performing terrifically this year, but last year they had a bang-up year as well and outperformed the S&P, which was also on a good tear. So I think it's a combination of that, but there's no question that there's a lot that's playing into just, this stable mix of the TSX and again, stable policy, all of that. So all of that's been rewarded in the price. And I think investors are seeing it as just having that mix of energy, materials, and again, income producing stocks. I mean, they have the banks, they have a pretty high dividend. All that's pretty appealing. When you're not certain where things are going to go, you're going to choose that, if you will, certainty and income. So I think that's helped a lot. Helped the index quite a bit. Clearly.
And again, so you delve a little bit further for me, though, Dec, too. So you talk about energy, we talk about materials. Those are the main drivers and the heavy lifters. But what else are we seeing strength from?
We're saying, well, it's certainly, if you look across, say, Canada and in the U.S., it's kind of similar. Financials are holding up there. For the most part, they're kind of holding in there. And the other thing, the consumer in both regions across North America is generally holding up. I mean, there's been a lot, certainly in the U.S., a lot of pain about, okay, what will tariffs do? Will they pull back? They haven't. They've been resilient. And the reason in both economies that things have held up is, for the most part, jobs have held up. And when people have jobs, they spend. And that's been a big part of, even though people have been a little uncertain about where the economy is going, they've still spent and they've still hung in there. So as long as jobs, remain good and strong, I think for the overall, the markets are going to follow that.
So we've seen some more losses, and again, still given the fact that we understand a lot of volatility in what's happening here, but Donald Trump last night maybe not providing as much certainty to investors and elsewhere with regards to the end of the conflict in the Middle East. But Canada and again, the U.S. overall faring well, especially, at least in the energy stress that we have seen, especially across the rest of the world. You look at the rest of the global markets and a number of other countries and areas of the world that have faced more significant losses that are, again, in more desperate situations. Who comes out on top here, though? Canada or the U.S.? I'm curious about your thoughts on that once we do finally see that conflict come to an end.
So I would overall, split the world into three parts. You've got Europe that's suffering just because they rely so much on natural gas, and those prices have let's say, roughly doubled. The same thing for Asia. And of course, because North America, both Canada and the U.S., are pretty self-sufficient, they're really, that has really put a banner, if you will, under their growth. So I see them really, really leading the field here, if you will. The other advantage, unequivocally, that Canada has, and we haven't talked about it yet, is like just fertilizer. That's one of those other commodities and short supply, because a lot of that originates out of the Middle East, and they're a big provider of that to the U.S. So I think in all of that mix, Canada is well positioned to, I think, perform alongside the U.S. And again, the energy independence or the energy self-sufficiency is a big part of that mix. But I also would point to the underlying earnings in the U.S. have been very strong. I think in Canada, they've also held in there. So there's a lot of the fundamentals that are also driving this. Whereas if you look at Europe, they're still trying to get, caught up, if you will, on the strength of their earnings. They're not certain where those are going. This is actually going to, and all the stress that's going on right now is going to put a little more pressure on those. And then, Asia is still in it's got a lot of this pressure from energy, but big economies like India are really, really struggling there. China doing a little better. Japan having, although their return or their stock market is doing well, or equity is doing well, they have been struggling a little bit on inflation ticking up and all of that. So again, you got to like the North American picture in the overall grand scheme of things here.
Yeah, again, a lot of factors, a lot of layers to this deck, clearly too. Before I let you go, I want to ask about some of the IPOs that we could be seeing. The major ones in particular, SpaceX, OpenAI, Anthropic. Also, there does it a potential $300 billion float. Is that meaningfully going to move markets? Because those are three significant IPOs that we could be looking at here shortly.
No, they're big. There's no question. And you're right. When you throw out the $300 billion, you'd say overall their total valuation might be $3 trillion, but they'll float about 10%. So you're absolutely right with your math there. That's probably what's coming into the S&P. But in the overall S&P, that's like 0.5%. Like that's a 50, let's say $60 trillion index. So overall, it's not going to change that. One thing that is riling a lot of investors is they're really going to fast track these guys. Because they're so big, they'll be so demand. They're all saying, okay, normally we'd have a 1-year wait period where they show they can generate profit, get used to being on an exchange, show some, if you will, good behavior, whatever. At this point or other, they're saying, no, we'll push them right in there. So that's going to be interesting because I think there'll be a lot of volatility back and forth as they settle into being, on a, formally facing investors, communicating and doing all of that. But a lot to look forward to here. And all three are expected to come this year. I think SpaceX has already put the paperwork out there. The other two are expected to follow. So yes, a lot going on this year.
Certainly going to be significant. One more thing to add this year, Dec, on top of that. Dec Malarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Appreciate your time today, Dec. Thank you. Well, a report published today by CD House shows that Canada is going to significantly boost defense spending, but what percent and what impact could it have on the GST in this country? We're going to have more on that after the break. Well, a new report from the C.D. Howe Institute recommending raising the GST by 1 to 2 points to help cover off some of the costs that it's going to take Canada to get to 5% contributions of GDP to NATO. Now, it also recommends cutting transfers to provinces and lowering benefits for well-off seniors for old age security. Joining us now to discuss the report is one of the report's authors, Nicholas DeHeer, a research officer at CD Howe. Nicholas, thanks for being here.
Thanks for having me.
So we talk about, this big defense spending. We've heard the Prime Minister all over the place and talking about, the tripling of defense spending over the next decade is what it appears that Canada's goal is going to be. It's a significant increase, and you're just wary about where that money is going to come from. So take us through your top lines of this report.
Yeah, so Canada is committed to spending 5% of its GDP on national defense, and we ran the numbers on that to see what that would do to federal finances. And frankly, the results are quite eye-watering. Under sort of a status quo scenario where the government doesn't really change how much revenue it brings in or what it spends, we project that the debt to GDP and the deficit to GDP will balloon over the next 10 years.
Okay, so we talked. Sorry, no, go ahead.
So our conclusion was that the government will have to take some action to accommodate the spending if it wants to maintain a sustainable fiscal regime.
Yeah, let's talk about those steps that they might need to take. I think one of the big numbers that jumps out is the tax increase. And you look at one to 2 percentage points on the GST. What would that generate, and where, at least for you, what did the numbers look like on that front?
Well, first I should say these are not easy choices. Nobody wants to pay more taxes. And we landed on a GST increase as part of a broader package. The government will this is such a big transformation in federal finances. Defense spending will be one of the largest components of federal spending, that it's likely to touch sort of all of those operations, both the revenue and the spending. So on the revenue side, we examined the GST because it was sort of the best of a bunch of bad options. The GST is a fairly non-distortive method of taxation. It doesn't drag economic growth quite the same way that income taxes do. So we favored it for that reason. And also, the GST credit is calibrated for 7%. This credit's designed to sort of compensate the disproportionately high amount of taxes lower income people pay toward the GST. And so we saw this as a pragmatic option in order to generate the additional revenue that would be needed to help keep Canada's fiscal picture healthy, and while meeting our commitments to NATO.
Yeah. So then talk about the spending side too, on the other side of the Nicholas. That's the revenue side, but on the spending side, there's in the report discussion about, some tough decisions about what the federal government could face here in the coming years if they want to get, because keep in mind, we just got to 2% of GDP, right? It took more than a decade to get to this point. Now they want to get more than double it. So on the spending side, what were some of the tough choices? What'd you look at?
Well, certainly a lot of the tough choices on the spending side are due to the context in which Canada finds itself right now. Concerns about economic growth, concerns about the trade conflicts with some of our trading partners, and an aging demographics will put increased pressure on spending as time goes on. And so why we suggest this sort of mixed package, putting a little bit of extra revenue from a GST credit, is that it reduces the hurt that would need to be done to spending programs. And we, for our purposes, we looked at sort of across the board reductions in growth. So what that materializes to is, if you look at budget 2025, roughly the level of expenditure that is in the year for the end of their projection horizon around 2030 is pretty much where we have it at 10 years under a healthy fiscal regime. So it's difficult choices. We go for that approach, but the government has more specific tools. They could adjust the clawbacks on certain income-tested programs, or they can negotiate some deal with the provinces. They have a lot more options.
So if we look at it as a whole, and before I let you go, and you look at this, at least for right now, is it regardless of what they do, minus the fact some significant cuts and that increase in the taxes, maybe the GST, this is likely to increase the federal deficit no matter what?
It will certainly do so in the short term. But if they make the choices now, by the time we are spending $150 billion a year, it is possible that we could see fiscal debt levels similar to today.
Okay, certainly interesting. Nicholas DeHeer, research officer at the CD Howe Institute. Appreciate your time today for us, Nicholas. Thank you.
Thank you.
Well, coming up, we're going to speak with Jean Pratt, the interim commissioner at the Competition Bureau of Canada, with some of their latest focus in regards to anti-competition measures in this country. Stay with us. So the Competition Bureau has released their 2026-27 annual plan with a focus on improving affordability and choice for Canadians. Joining us now to talk more about that plan is Jean Pratt, interim commissioner at the Competition Bureau of Canada. Jean, thanks for being here.
Thanks for having me.
You know what? This is interesting and fascinating. I think a lot of focus in this country, and maybe sometimes consumers don't realize that, and Canadians don't realize it, is how few companies are at different points we have in different sectors. So I'm curious, as we look at some of the top lines from your plan for this, at least to look at certain ways that we can talk about, enforcement to ensure that things stay competitive. What in particular, what industries, maybe start with this, are you looking at to ensure for Canadians that things are remaining competitive, across the board?
I think our focus for enforcement is going to be on essential goods and services that Canadians need every day. They're facing affordability challenges, so we want to make sure that we have vigorous competition to help address the affordability concerns in those essential goods and services like housing and food.
Okay, so we're talking about grocery chains, and we're talking about telecom, with cell phone plans, internet, along those lines.
Anything that is an essential good where Canadians are really facing some challenges, those are going to be the priority areas for us for enforcement.
Okay, and what kind of enforcement, are we talking about? What kind of measures, at least that now, that Canadians can speak to, something that they might understand that they're watching right now? What exactly you're looking at?
Well, I can give a couple of examples from the last couple of weeks. In our mergers work, we recently reached agreements with the owners of senior residents to make sure that those senior housing remains competitively priced, because we've got a lot of aging population. We've got people who are facing housing challenges, and we can't afford to see rental increases in that sector.
Sure. Yeah, that's a great one. Go ahead. No, go ahead with another one if you have another one.
We've also, we do have a lot of confidentiality around our investigative work, but we also have an ongoing investigation with respect to property controls in retail grocery. So, when companies are putting up barriers to others entering by putting restrictive covenants on places where new grocery could enter, that has been an ongoing investigation that we've had for a couple of years, and that remains a priority area for us as well. And another area that a lot of Canadians will know us for is the bread price fixing investigation and class action work. So that investigation continues to be a focus for us as well.
Another thing that Canadians will be, that are familiar with as well is hidden fees, right? And different costs that, that get rolled into, things that come to mind are airplane, flights, plane tickets. We talk about concert tickets as well, even sometimes ride sharing, all these different things where all of a sudden you see a price at the bottom of that. Talk about some of the concerns that the Competition Bureau has about those hidden fees in particular and how you are able to, again, identify them and then possibly crack down as well.
Well, it is a focus for us, drip pricing in particular. So consumers need to know that the price they see is an attainable price. So two of the cases that we have ongoing that people may be familiar with that are in litigation right now are against DoorDash and Canada's Wonderland. So we're taking action on those. There were new tools that were added to the Competition Act a couple of years ago through amendments, and those continue to be a focus for us. We are also consistently looking at any deceptive marketing that could impact informed consumer choice on essential goods and services. So that will remain a focus for us going forward as well.
Yeah, and I believe the auto industry, right, has been part of that and subject to that, I think, in the past, at least for now. I want to ask you, too, as well, the difference in educating consumers and businesses, the difference as well between made in Canada and a product of Canada. Tell us about that, because that one also stands out to us.
Yeah, so we do have published guidance for businesses and consumers about what product of Canada means and what made in Canada means. There are additional labeling requirements that relate to food that are not within the Competition Bureau's jurisdiction, but we're really looking at when you make claims of made in Canada or product of Canada, that they are true products of Canada when it's an agricultural product, and made in Canada, there are specific rules around how you can use that representation, which means that, a good part of the transformation of the product has to happen here in Canada.
Which is certainly interesting too as well. We also talk about relationships as well, at least for the Competition Bureau, the difference and deepening between international and domestic. And how is that, again, for Canadians, how does that play a role in helping competition in this country? That's, again, I'm assuming across all sectors.
We operate in an era of globalized trade, a globalized business, and so international businesses doing business in Canada are just as much a focus of our work, and we have ongoing cooperation with our foreign counterparts as well, so that we can work together to combat issues facing consumers internationally as well as domestically.
Yeah, okay. Give me a sense, just before I let you go, Jean, too, as well, just generally where competition stands in Canada. I touched on it off the top. Do you believe that we have enough of it? And then we talk about, at least for now, there doesn't necessarily seem to be a lot of choice in some certain industries in particular. But where do you stand on where we are right now as a country when it comes to competition?
We need more competition. There's no doubt about it. We need it urgently. I think, the senior governor of the Bank of Canada has indicated that competition is an urgent need. We need more than ever to unlock the power of competition in our domestic economy, given the headwinds that we're facing internationally, that Canadian businesses and consumers are facing. So, yeah, I unapologetically would say Canada needs more competition, and we need to work with partners at all levels of government to try to unlock more competition in our domestic economy.
Jean Pratt, Interim Commissioner of the Competition Bureau right now. Appreciate your time today, Jean. Thanks so much.
Thanks for having me. Bye.
Well, coming up, could we see an oil shock equivalent to the 1970s when oil prices tripped during the Middle East conflict? We're going to have more on the latest on that after the break. Industry Minister Melanie Joly says Ottawa can't bring cars in a kit to Canada to be assembled. Speaking in Vancouver, Joly also said the union and Ontario must support any Stellantis EV plan. The comments come after news that Stellantis is exploring plans to build electric vehicles with Chinese partner Leapmotor at its idle plant in Brampton, Ontario. Meantime, Ontario Premier Doug Ford says any deal to build EVs in the province would have to use local parts, adding that anything else would undermine Canadian auto workers. Shares of BCE, Rogers, and TELUS are seeing some pressure today after the telecom giants got downgraded by TD Cowen analyst Vince Valentini. Valentini says recent strength in the stocks has been due to investors seeking safety from geopolitical uncertainties. He adds that that aggressive low pricing seen late in the quarter is not fueling volume growth, but rather turn in negative pricing. Reminder that BCE is the parent company of BNN Bloomberg through its Bell Media division. And home sales in Vancouver saw a decline again last month. Data from the Greater Vancouver Realtors shows that a number of keys changing hands fell 2.8% in March compared to the year before. Listings also down more than 10%. The association says it continues to see fewer sellers stepping into the market than last year. It is also noting that the conflict in the Middle East is putting upward pressure on bond yields and fixed mortgage rates, which is expected to impact demand heading into the spring. Quick check on the markets, where again the TSX in the green so far today, which was not necessarily expected initially, but still showing some strength right now and some versatility with up almost 150 points too today, even despite what we heard from U.S. President Donald Trump last night, still sitting over that 33,000 mark. South of the border, things not quite as bad, but has clawed back a number of losses that we did see earlier too. S&P and the Nasdaq both just down barely. The Dow also, again, was down close to 1.5% earlier in the day. It has gotten a lot of that back, now just down over about 140 points. Well, U.S. President Donald Trump's address last night was supposed to calm the nerves over oil prices that have climbed more than 50% since the U.S. and Israel attacked Iran more than a month ago. However, in a conflicting message, he threatened to bring Iran, quote, back to the Stone Age. The Strait of Hormuz remains effectively closed, and how high gas prices might end up. Let's unpack it with more. Patrick Dehan, head of petroleum analysis with Gas Buddy. Patrick, thanks for being here.
Thanks for having me.
We talk about 50% increase in gas prices. It has been, sticker shock too, including at the pumps as well. Where do we, foresee this going? I'm not necessarily thinking, March 2022, or I think back to 2022 levels when Russia invaded Ukraine and we got up to, $2 a liter of gas in this country. Are we headed back there shortly, I guess, depending on how long this conflict continues?
Yeah, we certainly could. And diesel prices, by the way, in Canada, just under the $2.25 a liter mark, and that would be record setting. So here in the next 48 hours, I do expect that the Canadian average for diesel will hit a new all-time record high, and that's with, as you mentioned, oil markets, ultra-low sulfur diesel futures, all pointing to new records there for ULSD. And that is going to also continue to put upward pressure on gas prices, which nationally now stand at 180 across Canada. Now, I don't expect necessarily that we'll immediately see record prices for gasoline, but certainly the longer this situation goes, there's really no telling who is going to step in and act to reopen the strait, but something needs to be addressed there to stop the increases from occurring. Otherwise, we will likely see record prices for gasoline in the weeks ahead.
Yeah, we saw WTI hit $114 US a barrel at one point today. It's come back a little bit down at about 110, 111, at least for right now. There you go, a live look at it. So you talk about the Strait of Hormuz, and it's been such a point to and a sticking point in this conflict. Iran knows that it is its largest, source of leverage, at least right now, in regards to any sort of agreement that would end this. But it still doesn't sound, and even from the president last night, that there is any sort of indication that it could reopen. And I know that Britain is talking to a number of countries as well. Once the military part of the operation ends, they're talking to, to about 40 countries today about what it could like and what it would take to reopen the strait.
Yeah, exactly right. And that's where the needle hasn't moved yet. The president's talking about potentially the end of the war, but what nobody's really talking about is addressing the Strait of Hormuz. And that, to your point, Iran, if the U.S. leaves without addressing the Strait of Hormuz, Iran continues to gain that leverage. It's developing muscle memory. It is now interrupting global shipments, and it's not likely to simply just give that up anytime soon. So, whether it be the U.S. or its allies or other countries, something needs to be addressed before oil prices will eventually slow back down.
We talk about the price of gas in this country, too, and where we're at, how much significantly higher it is than even south of the border in the United States. What do you believe, where are prices going there? We've seen $4 US a gallon, at least for right now. Are they on track to continue increasing? And despite their production and what they're doing, maybe not quite as impacted as we are here in Canada?
Yeah, certainly the Canadian dollar and the currency strength does play a role here, as does location. To your point, I do think that the U.S. national average for price of gasoline could rise to $4.25 to $4.45. And what could also be record setting in the States is the price of diesel could very quickly approach that $6 mark. That certainly would be record setting. It certainly would be very ugly given how intertwined the Canadian and U.S. economies are. We're talking about a huge economic cost, trains, trucks, tractors on the cusp of agriculture season, all having to pay quite a bit more. In fact, several U.S. states now seeing diesel prices in excess of $6 a gallon. In fact, some areas of California now approaching $8 a gallon for diesel. So this is certainly far more development on this side of the barrel as diesel, and its huge economic cost the longer this situation in the Strait of Hormuz continues.
Yeah, that's wild. You think about some of those prices and exactly how expensive things are, in particular on the west coast of the U.S. right now. BC in this country also seeing that with the price of gas. And it feels like at this point, Patrick, too, as well, that the longer this conflict continues and we start to talk about, the trickle-off effects, the inflationary pressures and otherwise, but also the fact that these prices, even when the conflict ends, the longer it goes on, the longer it's going to take to rebound.
Yeah, exactly right. I mean, every day it will likely add at least another week to the recovery. in what's happened. I mean, we're at 4 weeks now. It could take at least 4 months, potentially beyond a year for some of these repairs, by the way, Qatar's energy infrastructure. So there's a whole cost to that, but it's going to take a long time, probably through much of the summer now, for the global supply chain to really catch up when things do start flowing. So, every day that goes by that nothing is addressed is probably another week or two that is added to the recovery time. And that recovery time now may take until the end of the summer, if not longer than that.
And let me just shift to, we talk about, at least at this point, we have the conservatives, the federal conservatives in this country, saying or proposing the fact that they want to cut the federal gas tax, that would save 25 cents a liter possibly or so. And we delve into a little bit of that. Is there anything else that Canada can do maybe outside of the Liberal government right now, making a move like that would see the price of gas come down?
Yeah, these are all very, very small levers. And to your point, the U.S. is trying to take some of those as well. Things like allowing E15, a different blend of fuel to be utilized during the summer. That blend 10 or 15 cents lower, I should say. For the Canadians, it would be more like 3 to 6 cents a liter if you can find it. That's the difficulty here. Now, when it comes to gasoline taxes, I mean, this is being discussed in various states as well. Politicians want to make things easier. We've seen talk about this in Canada, but to your point, when the economics are telling you that there's a huge imbalance between supply and demand, the wrong answer is to manipulate the market by lowering prices to incentivize more demand at a time that the market is telling you there's less supply. So as an analyst, this very much conflicts. My wallet would love it, but it certainly is danger of manipulating into free markets when you're doing something like this.
Yeah, certainly. Again, we talk about lots of different layers, lots of different factors. Patrick DeHaan, head of petroleum analysis at Gas Buddy. Appreciate your time today, Patrick. Thanks so much for this.
Thank you.
Well, coming up, home sales in Metro Vancouver dipped nearly 3% since last year. Again, we talk about where the housing market is across the country. We're going to talk about what the slowdown means there after the break. Stay with us. Well, home sales in Metro Vancouver are down by almost 3% with plenty of supply on the market, but demand that is not keeping pace. For more perspective, we're joined now by Andrew Liss, Chief Economist and Vice President of Data Analytics at Greater Vancouver Realtors Association. Andrew, thanks for being here.
Oh, thanks for having me.
You know what? I don't think that Vancouver is necessarily alone, but let's get into some of the numbers too and take us through what's driving some of this very vast, difference right now too between what's on the market and clearly buyers that are not there right now.
Yeah, it's been a story that we've been watching for some time. This is the part that makes it a little bit unsurprising, as I said in the press release. There just hasn't been that much demand over the past few years. And as a result, we've seen inventory levels climb. We've seen the similar dynamic play out in Toronto. It's happening in Vancouver. And interestingly, it's actually happening in most markets where prices are elevated relative to the recent past. So, it's really a market that's sort of trying to find that footing in terms of the buyer profile who's willing to enter into this sort of environment of uncertainty that we've been muddling through for the past few years. But as we're seeing this month, the sales really aren't down that much relative to last year. They are tracking our forecast fairly closely at this point. So I'm optimistic that we're going to see a spring that sort of looks a little bit like what we saw last year, which all in all, honestly, wouldn't be that bad of a shake given the way that things are going out there in the world at the moment.
Yeah, exactly. There's a lot of uncertainty, right? There's a lot of volatility. It feels like just buyers aren't ready to commit in a lot of ways, at least for now. But what about the price of homes too? We talk about sales, but where are the price of homes too in Vancouver too, relatively, at least for now, because we have seen them dropping in other parts of the country, including some of the biggest markets.
Yeah, so Vancouver's held steady a little bit better than a market like Toronto. Right now, if we look year over year, prices are down 6, 7, 8%, depending on the market segment that you're looking at. But, if you look at something like Toronto, in some cases, you might see price declines as large as 20% or so. So in a relative sense, Vancouver's not faring as poorly as a market like Toronto. Explanations for that are essentially that we don't have as much standing inventory relative to the level of demand as Toronto has. So that is one of those dynamics that's sort of keeping prices, a little less, keeping them from declining as much as what we've seen is in other markets. But that said, over the past few months, prices are really sort of stabilized. We're not seeing big moves in one direction or the other. Mm-hmm. And even for the past years, frankly, we haven't really seen big moves on any month over month basis. It's more been a very slow drip of maybe a 0.5% decline here, 1/3% decline there. And eventually, over time, you end up at a point where you're about 5, 6, 7, 8% down. But right now, past few months has been fairly flat.
Yeah. Now, again, I understand, too, that sales are a little bit skewed. And you look at the 10-year average, with what happened, especially over the course of the pandemic at different points. But that 10-year average sales right now, almost 32% below where Vancouver would normally find itself. If you look at that number, there certainly is that concern, correct, I'm assuming?
Yeah, and that's one of the tricky things with those longer term averages. As you pointed out, we have a couple of big years in those averages, which were not normal from a historical perspective. We don't usually see years around 40,000 sales or so. Typically, it's more around 30,000. And so with sales coming in last year, somewhere around 25, that is a decline relative to what we normally see for the year. But it's been a story that's basically been the same for some time. Sales really just have been trundling along below those 10-year averages for some time, largely because of that skewing effect of the fact that we have a couple big years in there. If you remove those years, we are still down on the 10-year average if you were to sort of do an average without those sort of outlier years, but not nearly as much.
So the outlook isn't necessarily great, right? And have we heard, that some builders, are walking away from pre-construction projects at this point? Sounds a little bit concerning. We also talk, on the other hand, too, the federal government wants to take action in some of these markets. We've seen what has happened in Ontario in particular. We talk about Toronto and the HST relief that buyers of new builds that are going to get, at least for right now. Are you hopeful that you could see something like that in BC as well, some sort of agreement that could spur some of the sales?
Oh, that'd be great. We would certainly welcome, any kind of agreements that would spur on, especially new development. If you've been following the story of Vancouver real estate for some time, you'll know that one of our main story has been we are a supply constrained market. Now, right now, obviously, there is some standing inventory available that's higher than what it's been in the past, but by no means is it some significant level that's so high that prices are falling to what most people would call an affordable price point. And I think that what a lot of policymakers have been vying for many years, but haven't really been able to achieve, is this significant boost in supply. And right now, you have a market in which prices are coming down and so on, which is not so great for the feasibility of new development. And so in order to get new development happening and getting that supply to market, which will keep prices from escalating in the future, we really could use some incentives. That would be very welcome at this point in time. But it would also be nice to see those things put in place permanently as opposed to just a one-time fix.
Yeah, which again, we are seeing, and whether it's a couple of years or not, at least in Ontario from the federal government. I'm curious your thoughts too, Andrew, before I let you go as well. Given where we're at economically, what we're seeing in the markets too, the increase in bond yields that have gone up, which is also going to push up the price of fixed term mortgages too. Is that a concern right now for the association, or again, it's lower on the scale, at least for now?
I would certainly put it at the lower end of the concern spectrum. However, rising bond yields, as you just noted, do have a pass through into fixed term mortgage rates. So, that's one of those tricky parts right now, is that as rates rise, we typically see a dampening effect on sales. Whether that'll happen this spring is a bit of a question mark, because we already are operating at fairly low levels of sales, from a historical perspective. So how much lower will they go is a question. And what we've sort of observed in our market for some time is that a lot of the demand that we're seeing right now that is actively making those trades is really end user demand. And this is the kind of demand that's driven by life choices as opposed to, investment decisions, which may be less sensitive to something like interest rate increases and mortgage rate increases. So it'll be an interesting spring to watch to see how the numbers shake out. I think we're still going to track our forecast fairly closely, but it certainly is hard to ignore that large kind of elephant in the room right now of this global uncertainty and these impacts on financial markets.
Yeah, certainly I don't think Vancouver alone in watching that and the impact too on the real estate market right across the country. Andrew Liss, Chief Economist at the Greater Vancouver Realtors Association. Thanks so much for your time today, Andrew. Appreciate this.
You're very welcome. Thanks.
Well, still ahead, today's Market Movers with Bloomberg's Matthew Griffin. Stay tuned for that. Well, time now for some movers south of the border, joined by Bloomberg equities reporter Matthew Griffin. Matt, let's dive right in, shall we, too? Very interesting with a couple of these ones today. Let's start with Blue Owl Capital. You talk about some of the concerns and some of the uncertainty about private credit, but down today. Take us through why.
Yes, well, Matt, thanks for having me on. Blue Owl, I would say it is more of the same that we've heard from private credit companies recently, but we really haven't seen numbers like this. So 2 Blue Owl private credit funds are limiting redemptions, as we've seen from other managers. But if you look at the percentage of capital that investors asked to pull out, the $36 billion Blue Owl Credit Income Corporation, investors looking to pull out about 22% of shares from that fund. A smaller fund, Blue Owl Technology Income Corporation, that was a request there for more than 40% withdrawals. Blue Owl will be capping redemptions at 5% for both funds. So again, Blue Owl has kind of been at the epicenter of concerns about whether there are cracks showing up in the private credit ecosystem. They had the scrapped merger of 2 business development companies end of last year. You had really high withdrawal requests in January from one of these tech-focused funds. And these numbers we're seeing today really adding to investors' concerns. You've got their shares rebounded a little, but they were down as much as 8.7% earlier, that was a record intraday low level. And you've also got larger peers like Apollo, Ares trading lower as well.
Yeah, certainly you've seen the runoff and the impact and some of the concern about that, at least for right now, but a record low already on the day today. Let's go to Tesla now, too, shall we, Matt? You know, a lot of talk about SpaceX, Elon Musk, the possibility of being a trillionaire with the IPO there, but Tesla not necessarily having a good day today either. They missed some EV sales targets.
No, and Tesla just now extending declines to about 5.4%. That's their worst day since November. The car maker, like you said, reported EV sales that missed estimates for the second straight quarter. They sold or delivered about 358,000 vehicles. Wall Street was looking for about 372,000. It was actually a slight increase from the same quarter a year earlier, but think back to what was going on then. You had production shutdowns. You had this consumer backlash to Elon Musk's role in the Trump administration. So if you set that aside, this is actually their lowest number of deliveries in a quarter since mid-2022. And you're right. We think about Elon in the context of SpaceX. We think about Tesla in the context now, or at least investors do, of artificial intelligence, humanoid robots, robo-taxis, these sort of futuristic bets the company is making. At the same time, the part of the company that throws off the cash to pay for all of this, that's that legacy, so to speak, even though they're new technology, EV business. And that is really front and center for investors today.
The other one, too, is fascinating to me. So Dine Brands gets a downgrade. This is the owner of Applebee's. And the reason why is a little fascinating.
Yes, so I'm doing all decliners today, not to be a Debbie Downer, but we look at Dine Brands down more than 7% at its lowest point today. This is the owner, yes, of Applebee's, IHOP, sort of chain value restaurants. They got a downgrade at KeyBank, and they're citing Applebee's there. They're turning cautious on the direction of what they call the direction of the trends at Applebee's. And they're citing winter weather. You remember we had some pretty heavy snow on the East Coast this winter. I'm here in New York. I experienced it myself. Not the kind of thing you want to go out to dinner in. And you also had the macroeconomic backdrop, a lot of consumer uncertainty. And even though this is a value chain, what KeyBank says is they might get more competition as other chains look to focus on value with the consumer under pressure, facing a lot of uncertainty right now.
Yeah, certainly interesting, too, again, with that winter weather. We were well aware of that in Canada, too, here, Matt, with all the snow that we've gotten.
I can only imagine. Right
across this country. Bloomberg's Matt Griffin. Appreciate the time and the insight today, Matt. Thanks for this.
Thanks for having me.
Well, let's have one last look, too, at the markets before we leave you for the end of this hour. Things are still in the red, too, pretty much right across the board in the U.S. But keep in mind, at least for now, was that these numbers were much higher earlier in the day today. Not as much certainty for investors. They were looking for more of it from Donald Trump last night about the end to the conflict in the Middle East. The Dow on the bigger end of that right now, down almost half a percentage point here, at least so far in trading today. But it's been a very volatile week. Most of the major indexes still on track for gains so far overall this week, because keep in mind, markets are closed tomorrow for the holiday and Good Friday. The TSX, though, in Toronto, still in pretty good shape. It's on the green side as well, up 100, over 100 points, too, at least for now, still capping that 33,000 mark. So, again, a little bit of a response today after a significant drop that we did see earlier. Let's check on oil, shall we, too? At least for now, did touch WTI. Hit 114 US a barrel earlier today. It is now back down to 111, but still, we talk about those increases. We are certainly seeing that today. That's wrapped up this edition of Trade Today. Thanks for being with us. Stay tuned. We'll have more coming up a little bit later.